Seated so that we can start with our next session. We'll just take a minute to set the stage towards it. This is on advancing green finance for a greener ambition. We have been talking about the greener ambition, the targets which we have for India, 500 gigawatts of non-fossil fuel capacity by 2030. That's going to be requiring huge investments. And as per a study, investment of more than 500 billion USD at the system level. However, as we are all aware, the economy, the global economy across the world in countries, we are grappling still with the fallout from the COVID-19 pandemic. In this kind of a scenario, we look into how do we work on a more cohesive and a more friendly investment ecosystem for the clean energy sector. The panelist here is going to be discussing on the green finance taxonomy by financial institutions, the necessity to institutionalize domestic green finance. They're also going to be talking about and discussing about creating awareness and capacity among the financial institutions regarding the green finance. So I invite our moderator of the session, Mr. Srinivas Krishnaswamy. Mr. Srinivas Krishnaswamy, the CEO of Vasudha Foundation, which has been working towards also the conservation of Vasudha, that's our earth, and promoting sustainable consumption of earth's bounties. We have Mr. Ashish Tiwari, the CEO of Koscher Climate, inviting Mr. Saurabh Maggo from Actis Fund. Our next eminent speaker, Mr. Pankaj Sindwani, Chief Business Officer, Tata Cleantech Capital Limited, and Mr. Satyaki Bhattacharya, Renewable Energy and Infrastructure Expert, World Bank. So we have targets, ambitions, and as we work towards these targets and ambitions, the investment plan towards it, discuss and deliberate in this. So I now request Mr. Krishnaswamy for the further proceedings of the session. Thank you, sir.
Thank you very much, and a very good afternoon to all of you. This session, I would say, which is advancing green finance for a green ambition, I would say is extremely important and timely in my view, primarily from two sort of facts. One is that India has committed to a very ambitious renewable energy targets, looking at the 2030 targets and going beyond even the 2070 net zero targets. And going beyond the renewable energy, if one would look at the entire energy landscape, there are also other announcements like the hydrogen mission that Dr. Ajay Mathur alluded to, and then we also have the electric mobility by 2030 target, and so on and so forth. So if you're looking at all of these and beyond, and particularly from a net zero by 2070 scenario, the kind of investments that would be required is of very, very high magnitude. Now, in the backdrop of this, we have an excellent and eminent panel of experts working in the clean energy financing space who will throw light on the various ways and means to meet this huge investment requirements to meet the goal of both the 2030 targets to start off with and then going beyond the 2070 net zero. We have with us Mr. Pankaj Sindwani. Pankaj is the Chief Business Officer at the Tata Cleantech. He is tasked to build the climate finance business across mainstream and emerging sectors. He has a broad experience in sales and marketing, manufacturing, operations, and corporate strategy. We have Saurabh Maggo, who is the head of M&A investments in Blue Pine Energy, which is a wholly owned subsidiary or organization of Actis. He has immense experience in M&A transactions in the energy sector across Asia. Then we have Mr. Ashish Tiwari, Ashish Tiwari is the CEO of Koscher Climate India. He is an expert in the renewable energy project development with a demonstrated history of working on Indian and international energy projects for over 2 decades. He has delivered over 2 gigawatts of RE projects in India, Thailand, and Indonesia. And then our fourth panelist is Mr. Satyaki Bhattacharya. Satyaki is with the World Bank. He is a clean energy and infrastructure finance expert. He is an experienced renewable energy expert with a demonstrated history of working in the international trade and development industry, skilled in business planning, operations, management, analytical skills, power plants, and conceptualizing and implementing programmatic approaches to solving complex renewable energy projects. Now, in terms of the structure of this panel, with the permission of the panelists, I would like to sort of propose the following. A is that I would open up the floor for a 3-minute opening remarks from each of the panelists, and sort of with a very broad framework on what the remarks could be. It could go beyond that too. And then after that, we would have a round of questions pointed to each of the panelists. And if time permits, and with the permission of Mr. Giri and the organizers, I would also like to open the floor to the participants in case there are any questions specific to any of the panelists. With that, to open up the question and to have one opening remark, have an opening remark from all the panelists. I would like to sort of start off with, there are a number of figures floating on the required quantum of investments, either in the form of debt, equity, or others, to scale up renewable energy to meet our 2030 targets. And the numbers vary from a few trillion to whatnot. So in your view, what are the quantum investments that India should be looking from a green energy perspective for the short, medium, and the long-term period? And going further, I would also like to add another supplement to it. In the light of the Glasgow climate meeting, which reiterated that developed countries should definitely put that $100 billion that they promised way back in the sidelines of the Copenhagen climate meeting, which they have still not met, and ramp it up further, well beyond the $100 billion commitment. What do you see any hope in these international finances coming through? Or should we look at just domestic, or what do you think would be the role of international financing? And how much do you think, what role that could play, both in terms of quantum as well as in terms of meeting our targets? I would like to now, so the panelists, we could start off from Saurabh.
Sure. Thank you, sir, and good evening, everyone. Thank you so much for having me here and giving me this opportunity to present my thoughts on advancing the green energy financing. This is a very pertinent topic, especially given the fact that we are talking about a 500 gigawatt target by 2030. That's a very steep and ambitious target, and a lot of things will have to play right in order to for the country to achieve this kind of a target. Talking about numbers, but before that, I think one special mention for the PLI scheme, which the government announced in the current budget. I think $26 billion of financing specifically to set up solar module manufacturing capacity in the country. That is definitely a good step in the right direction to get to this 500 gigawatt target. But more importantly, financing has to be addressed because we're looking at like very large numbers. Back of the envelope calculations state that if we have to look at a 75-25 mix of solar and wind in this 500 gigawatt target, and I'm talking of a 4 crore per megawatt capex for solar, somewhere between 7 to 8 crores for wind, we're looking at a capex of close to $250 billion over the next 7 to 8 years. Now that's huge, and if 70% of that comes from debt, we are looking at a $175 billion of debt financing. This is unprecedented in the country. I don't think any particular sector till now has had this kind of allocation till date. The question is, where would this capital really come from? Till date, we've had 4 major pools of financing in the country. The first one has been the domestic lenders, both the banks and NBFCs, public sector, private sector. They have been the mainstay of lending the debt pool to the renewable energy projects in India till now. And given that they've evolved so much over the last 4 or 5 years and the kind of learnings that they've had working with the developers, my belief is that they would continue to be the mainstay for debt financing in the country. So that is one large pool of capital which has to be enhanced if we have to go and achieve this 500 gigawatt target. Another important pool is domestic bond market. Now, corporate bond market in India is fairly shallow, and their exposure to renewable energy even more so. That being said, the sector is evolving. We've seen a lot more domestic debt funds starting taking exposure, at least at the holding company levels, for various renewable energy projects. But this market really needs to deepen for us to be able to lend meaningfully to the sector. Then we have two another pools of capital. One is the multilateral lenders who have done their bit part in especially supporting the new technologies when it comes to hybrid storage and so on and so forth. And the last and the most evolved one is international bond markets. So this is the latest pool of capital which opened up massively. And a lot of IPPs, especially the reputed ones backed by good sponsors, good funds, have been able to tap this fairly successfully. So I think all these four pools of capital, along with newer ones, will have to come up in order to achieve this 500 gigawatt target.
Thanks so much, Saurabh. Pankaj, your take on it?
Thank you. Let me just start with a brief introduction to my organization, which is Tata Cleantech, and I'll come to why that introduction is important. So Tata Cleantech is a joint venture of Tata Capital and IFC Washington. This started as an experiment almost 9 years back. At that point in time, we didn't have a dedicated private sector climate finance institution. And we weren't really sure, what will be the journey like, what we will be, 7, 8 years down the line. And here we are. We have an asset book of close to $1 billion. We must have funded more than $2.5 billion worth of projects, almost 320 projects. Only one has turned an NPA. And why I'm now saying it is important to understand this, our return on assets probably is the highest in industry across asset classes. So this goes on to bust that myth that if you are doing something in the area of development finance, it needs to necessarily compromise with your returns or your shareholder expectations. It is not so. So we've been able to learn and demonstrate that it is indeed possible that your goals could be developmental, but your stakeholder returns could still be commercial. So, and that is how we've seen the market evolve from 200, 500 megawatts to now 110 gigawatts. So that has happened because it has had economic viability, not just for us, but for the rest of the industry also. We've seen examples after examples where private equity firms have given exit to strategic players at record valuations. This is happening because there is so much of interest in the sector. Coming to the figures, and Saurabh has already alluded to it, it is indeed right. The figures that are being bandied about are in the vicinity of $250 to $300 billion. And yes, much of this money will come in from the traditional sources of debt and equity. But I think going forward, and I have always believed the problem is not just finance. Finance is probably easier to tackle with. The bigger issue is that of policies. So we've seen if your policy framework is right, if you have the right kind of incentive structure built in, you have the right kind of payment security mechanisms, money always follows. This we've seen in sector after sector. So we should not try and create solution for a problem which does not exist. So we first need to tackle the critical policy framework issues, and some sectors they have already been tackled with, and therefore in those sectors we do not see any issues of finance availability. For newer sectors, we will need innovative policy framework, long-term sustainable policy framework, and till such time that the policy matures there, you'll of course need various instruments. It could be in the form of first loss risk guarantee, it could be in form of credit enhancements, and there the role of multilateral institutions will be very, very important. So private capital will come in once your policy framework is mature and they have long-term visibility of the scale and pipeline. And till such time that it happens, I think multilateral institutions and the governments need to make sure that they handhold the sector and bring it to that stage. So I think these are the things which are important for us to be able to reach our 500 gigawatt story and even beyond. Thank you.
Thanks, Pankaj. Ashish?
Hi, so I'm Ashish from Koscher Climate, as mentioned. So basically, if we want to achieve 500 gigawatt by 2030, so in my opinion, it will be a sustainable finance and not only the green finance. So because Madhusudanji and I think Bhapeshwarji, they are here and they are veteran in the industry. So we know that around 30 years back when we used to go to the villages to install a windmill, whole villagers used to come us and greet us and they help us. And around 15 years back, the trend changed, and if you are one of the vehicle, you enter into the field and then they create the ROW issues and they ask for the lakhs of the money. So when we'll reach that 500 gigawatts, so we have to see that what all we can do to avoid these situations. So as right now I'm working in this culture climate, so we are one of the consultant agency to do the carbon advisory, and top of it the sustainable development. So in sustainable development, that UN also has the guidelines, and there are 17 parameters out of it. And if we see in carbon finance, or what we see the international guidelines which will be going to come maybe in a year or two, and for the sustainable development and the sustainable finance. So these 17 parameters will be very important, and especially if the countries like India, if we will do something on the sustainable developments, and definitely ROWs and the issues with the land cost and other things will be resolved, and I don't see that financing with related to ROWs or other challenges will be an issue. So the people who don't know the SDGs, so some of the SDGs are that no poverty, zero hunger, that good quality, gender equality, and a lot of things are there. So what we have seen in last 10 years, that CSR is the part of that government regulation also, that as per the government, some part of it of our operation has to go to the CSR activity. Similarly, what we see in India also, some portion will be definitely go for the sustainable development in operations also, and there will be a lot of scope that we see that in 500 gigawatt there will be the demand from DISCOMs, only DISCOMs. But what we see in 2026 when CABM will be implemented, then a lot of countries in Europe, they will require the steel or power or car or whatever may the commodity with some green on it, and then whatever that we are exporting from India to Europe, they will definitely need the green power. So as of now, green power is not mandatory by the industry, but maybe in coming years it will become mandatory due to change in some international standards.
Yeah, thanks Ashish. Satyaki?
Yeah, so thank you. I'll quickly go through and give you a brief introduction, but my friend Saurabh has really helped me by giving out the numbers here, which is $250 to $275 billion, and we are at the part 3, which is the multilateral lenders. And honestly, if you look at it for all the multilateral lenders, World Bank and a World Bank group, World Bank and IFC, ADB, AIIB, all of them combined, we probably can reach around $6 billion of clean net finance per year. And the ask is 250. So chances are, the multilaterals can only do that much, but what we can provide and what we do all the time is a lot of regulatory work and a lot of policy building. So chances are when you look at, say, the first stage of the first hybrid in India, I mean, it was kind of World Bank and SECI working together. The project had issues because of the Andhra Pradesh PPA, which is what I don't want to go into. But this is what the World Bank usually does, and just not World Bank, all the multilaterals. We come in, we provide the policy support, the regulatory framework, help with that, something like the real-time power markets, and then we move out. So what we provide is a lot of regulatory support, the finance plus, technical advisory. We open up the market, we provide some kind of grant financing, and we see to it that, the market is de-risked. And based on a lot of due diligence work, other agencies can come in and the money can flow in. Because as somebody has pointed out, the funds are not an issue. A lot of people are afraid about how do we go and invest this money and can we make money out of it. Everybody wants, I mean, nobody's in a charity here, but people would also not want a windfall gain. A reasonable 9 or 10% profit is what a lot of companies are looking at, but they want it to be de-risked. So there are a lot of investors who are looking to probably put their money in, and they don't know whether it's risk-free enough. So our multilaterals also kind of provide that platform for a lot of de-risked business models. I'll quickly end here and we can, thank you.
Yeah, thanks so much. Changing the order, coming to you, Pankaj. You sort of referred to, the need for policy framework. Now, yes, there's been an increasing recognition that policy uncertainty can reduce investor confidence and so on and so forth, and potentially raise the cost of financing. Now, how do you think, or what, in your views, are if I were to ask you to list out, say, 3 policy frameworks that is absolutely essential to be brought into the country, what are they? So, for example, is recognizing the qualifying taxonomy for green climate finance, would that be one of them? Or what are the other 3, or what are the 3 broad policy frameworks that you think would be required to increase investor confidence?
Sure, thank you. That's an excellent question. So, as we have seen within this panel, right? So many terms being used. We are talking of climate finance, green finance, sustainable finance, energy transition finance. So, what is the real definition? And if you ask individuals of the meaning of each definition, chances are that their understanding will be very different. And chances also are that their understanding of what is required to be done also will be very different. Earlier on, we spoke about trillions of dollars, then we came to $250 to $275 billion. And the fact is the money which is required is anywhere between $250 million to $1.5 trillion, depending on what you are looking at, right? So $250 billion is purely for renewable energy transition, right? So energy transition is much more than that. It goes beyond electricity. Electricity is just about 18%. Now, if you look at the scale of investment which India needs, right? And therefore, green taxonomy is so very important. It provides the definition of what is green finance, so that international investors exactly know that this is what they're investing in, and this is indeed getting qualified as green. And it needs to go beyond renewables. It needs to cover sectors such as, air pollution, for example, water, eco and biodiversity. All of those sectors are equally important. The other factor which is important is there is something called EIA, Environment Impact Assessment, right? Those standards are today, to be very honest, very loose. They need to be strengthened. They need to be upgraded. That's another area where we need to work on. Another important point is, even today we are looking at, test conditions when we announce, for example, emission norms for vehicles, right? Those need to mimic real life situations. So all of this will go a long way, avoid greenwashing and looking at what is really green, and investors will also have that much greater confidence in investing in those, sectors. In fact, just to give you an example, within our neighborhood, China and Bangladesh also have a clear definition of what green taxonomy is. And I think it is high time. EU, of course, has also announced taxonomy. So I think it is high time India also adopts it, specifically now that we know India needs so much more money, and India is highly dependent on international capital coming to India, private international capital coming to India. And just to give you a figure, so far, less than 5% of what India has invested in climate change has come in from private international investments. So there is so much more that needs to happen, and green taxonomy can go a long way.
Thanks so much, Pankaj. Now, changing gears and coming to you, Satyaki. You did say that the multilaterals can do only so much, and we have a very, very huge requirement of financing to meet our 2030 targets. But I do know that, if I'm not mistaken, the World Bank and the other multilaterals do play a major role in de-risking investments for green projects. Am I right? And if that's so, what role does the World Bank play, and what are the ways and means of de-risking investments for green projects in India?
Thank you. Pankaj, thanks for putting up the ESI out there. I think people do ignore it at times, much to their peril. Thank you. So I'll quickly go through this. So the World Bank, amongst the other multilaterals, is the largest, should I say, custodian of donor funds and grant financing globally. And we channelize this for clean energy projects all over the globe, mostly a lot in Africa, South Asia, East Asia. So how do we kind of de-risk the investment? So I'll take a quick example. We talk about floating solar projects. So once we had a request to kind of fund a floating solar project for SECI. So to understand what are the perils of a floating solar project, the World Bank ran studies for 2.5 years. We got DNV and Ernst & Young to run business models and technical specs. So the tech specs were ready, and we figured out what are the gaps in the tech specs. We got Terry to run a full project mapping 2,100 reservoirs across the country, 5-year data, GIS based, to see to it that what is the minimum reservoir drawdown level at which you can do this. These are specific things we do to de-risk the model. So when you go in and, so if an investor says, which are the reservoirs where I can take a look at for FSPV? So that is a public data. It is integrated with the global solar atlas. You go there, go to the drop down and look at the India's 2,100 reservoirs which are fit for floating solar. And then you look at a detailed data for 100. So 100 reservoirs in 5 states, we said these are ready to go. I mean, we don't invest. I mean, it has nothing to do with our investment pipeline per se, but we saw to it that we tried de-risking the business model. And this is a specific case. Then we went in, and for the project we were about to finance, we ran multi-beam sonar studies, wave studies, and bathymetry for months and months. So if you ask me, this is a specific example on how I should like to do it. So then the World Bank wanted to do a hybrid project in Andhra Pradesh. We went in, asked SECI to put up met masts, ran the wind study, ran the entire, we took total stations and mapped out the entire place. Is that the work of a financial institution? No, ideally not. I mean, you pay the money and you get out because, well, it's a SECI, it's a Government of India entity. But the whole idea is to provide enough data in the public domain. So once we provide the patient risk capital for the first few investments, we show how this can be done, how the sector is de-risked, then we automatically move out because our kitty is limited in terms of financing. But what we do is we show that it can be done. As Pankaj has pointed out, is it possible to have investments in renewable energy sector make money and be responsible? Yes, it is possible. But the de-risking part is where World Bank runs studies, just not World Bank, ADB, AIIB, AFD, KFW, all of us. A lot of our work is basically running long-term due diligence, which might or might not be linked to directly a financing pipeline. So this is what we do. And the finance it's there. It's like a 20 or a 25-year loan. So one part is, it is exactly for that long-term patient capital. And then we continuously work with all the stakeholders, the EPC contractors, the suppliers, the policymakers, the regulators, and people who are interested in the entire industry, in the entire value chain, to come in and put their ideas, and we discuss with them. So ultimately, when people talk to each other, the grays are, the unknown areas are figured out, and then we try and address them. So we break it down into individual components and attack them at those places, and I think this is what all the multilaterals do well. Instead of saying that, oh, I have a Government of India guarantee, honestly, I don't care. DEA signs a World Bank loan on behalf of the thing. So if you think about it, it's RBI backed. Do I care? Honestly, practically you think, oh, nobody has ever defaulted, so why do you care? We care because we can only provide you $1 billion a year, but the industry needs 45 to 50 billion a year. So that entire structure needs to be de-risked, and the World Bank does that. We provide enough data and enough information in the public domain for people to come in and put their capital, risk capital in industry. So that's how the World Bank does it. Thank you.
Thanks so much, Satyaki. Now that we have heard of the various ways and means of de-risking investment in the World Bank, I would like to turn to you, Ashish. From your experience, and you sort of alluded to very briefly in your opening remarks, from your experience, what are the challenges faced by developers in raising green finance in India?
Basically, as of now, what we are facing, the major difficulties, because tariffs are very low, and there is a difference of 1 paisa in the L1 and the H1 on the winner side. So, and there are a lot of uncertainties. As I told earlier, there are ROWs, land cost is not in the hand. Sometimes there are issues related to transmission connectivity and some change in regulations. And for example, the change in regulations, or it is already covered in the PPA, but which we see it's more than, I think, 3 years that GSTS came, and still, some of the IPPs, they haven't got the GST benefit from the SECI or any other agency. Similarly, that some people won the project, and we seen a month or two back, additional duties there, around 40% duties there on the panels and 25% duties there on the solar cells. So, that this kind of situation, that it becomes difficult to get the easy funding from the lenders. And what we seen that everybody talks about the 243 tariff of the fourth bid of SECI, but out of that only one project is commissioned, and for remaining 3 projects we don't have any idea. So, yeah.
Thanks, Ashish. Saurabh, in your opening statement, you were talking of innovative new instruments are required. In addition to that, what are the new tools that the government should explore for green financing in the RE space? So there's been this whole discussion of a solar bank, and as recent as a couple of days back, there was this proposal of a credit guarantee fund for renewable energy. But of course, that's global. But what do you think, what are the new tools that the government should explore?
Oh, there are a lot of them, to be honest. We can, actually, a lot of them are actually pretty simple to implement, the low-hanging fruits. To start off with, one of the largest problems with a few large private sector banks is that they were the first movers when electricity generation got privatized in early 2000s. And therefore, they are struggling with their power sector exposure limits today. What can really help is, or as you asked, what are the tools that government can use to ease out the financing? What can be done is, if renewable energy exposure can be separated from the power sector exposure overall for these banks, because these are like literally very large private sector banks and have huge amounts of capital which they can lend. And they are growing at a very rapid pace, lending to other sectors. But because of their power sector exposure, they are constrained in lending to our sector. So this will go a long way in freeing up the limits for these banks. Additionally, what can be done is that, and please correct me if I'm wrong, but currently small-scale rooftop installations do come under priority sector lending for a lot of banks. If that can be extended to utility-scale projects, then every bank in the country will have to comply with the PSL norms, lend to the sector, and that will again open up a large pool of capital for the sector, for the RE developers. Thirdly, as you just mentioned, we all read about this idea with the government pitched globally that we should have a global green energy bank. That's a good idea, I think a step in the right direction. And from a government perspective, they can go a step further and have an India dedicated green energy bank to support the renewable developers in the country, because at the end of the day, we are the third largest renewable energy market in the world, and a lot of capital is needed here. So that would be another step in the right direction. A couple of more things can be done. While private sector lenders have been fairly proactive, a lot of PSUs and multilaterals have been constrained by their overall policies. So in a lot of discussions with the lenders, PSUs and multilaterals, we hear that they can't increase the leverage beyond a certain debt equity ratio because it's part of their policies. We are essentially a cash flow based backed businesses, right? So rather than looking at these assets on a debt equity or let's say asset base, it should be a cash flow based financing. You solve for a target DSCR and leverage can go to whatever levels it can go to. And that is really the optimal financing which the sector needs to unlock. So that I believe is another initiative or another tool which can be used to enhance or ease the financing. And lastly, most importantly, the elephant in the room, which is the discoms. I mean, they're the weakest link in the entire value chain today. So if something, I mean, discom privatization has been talked about heavily, but then it has its own set of issues. But if something can be done to resolve the bottlenecks that discoms have today, and the payments can start coming on time, that really enhances the credit quality of the projects. And the state PPAs can become as powerful as the central PPAs in that case. That has a multifold effect because the cost of the rating of the project goes up, the cost of capital goes down, the cost of power goes down, and it's a win-win situation for everyone. So, I mean, I think all of these combined together will definitely step by step lead to a better financing in the country for the sector.
Thanks so much. Since we have just about 7 minutes, I would like to, are there any questions that the audience would like to ask the panelists? I have time for about 2 questions. Okay, maybe we'll do a closing round from each of you. Any thoughts on this? Any closing thoughts on this? Feel free. And we can start off with you, Saurabh.
Thank you so much. I mean, we've discussed extensively on the policies, on the regulations. Just one anecdote which I would like to give here. And this is coming from a discussion with a pool of ECB lenders who are not very active in the country today, but are trying to jump on this bandwagon. Coming out of a negotiation on one of the term sheets with these lenders, typical discussions have a lot of fighting, a lot of pushbacks, and a lot of fights. After the discussion got over, I was generally chatting with a few of them, asking that, there are so many issues that you're envisaging in the sector today. So what makes you still come to India and explore financing the renewable energy projects? So what they mentioned was that, in the Asia-Pacific region, they've explored a lot of geographies. There are geographies like Australia, which are totally unregulated. There is no certainty on the PPA tariff. There are no PPAs. It's an open market. And then there are geographies like Thailand, Indonesia, Philippines, which are not large enough for them to lend meaningfully. The policy is not very stable. So despite all the issues that we face today on the policy front, I think credit has to be given to the government. Because as per those lenders, India still is one of the most stable policy regimes that they have seen across the continent. And I think that is one big reason why the sector has come up in the way it has come up. So, I mean, that's my closing thought. A lot of good work has been done. A lot of ground has to be covered, but I believe we are all moving in the right direction.
Pankaj, your closing thoughts, but I would also like you to cover on what are the ways of increasing the leveraging capacity of public finance in the clean technology space. If you could also throw some light on that.
Yeah, thank you. So, I was likely to cover that in my closing remarks anyway, because I think past is not an indicator of future, right? We need to reimagine, rethink what our strategy is going to be like for next 10, 12 years. And therefore, if you For instance, in the last session, Dr. Ajay Mathur was talking about green hydrogen. Now, if you look at green hydrogen today, it costs roughly between $1 to $2. It costs about $5. Our aim is to go to $1 to $2. 70% of the cost is attributable to the reduction in the cost of energy, right? And cost of energy can come down if you're able to bring down the cost of capital, right? So it is possible to go down to as low as 1 cent per kilowatt hour of power cost if your capital cost is, say, 1 to 2%. So what role can all institutions play so that you have a specific usage set or application set for green hydrogen? Green hydrogen, by all estimates, can absorb as much as 60, 70 gigawatt of renewable power. So what is it that we need to do to make sure all the elements, whether it is multilateral, blended finance, whether it is private capital, so that we are able to define what is it that we need to do together to be able to scale the industry from, we've been doing 10 to 15 gigawatt every year. We now need to scale at much greater speed. And all of that will be possible only if we are able to think out of the box innovatively, and there we'll need a lot of help from multilateral institutions and, more importantly, developed nations, either through institutions like GCF or through other mechanisms. Thank you.
Thanks, Pankaj. Satyaki, your thoughts, your closing thoughts, but I would also like you to throw some light on how can we diversify climate finance options.
Yeah, thank you. So I'll quickly cover up something. So the first part is often the multilaterals, they work on a lot of, should I say, but pioneering things. Like we are working on huge hydrogen projects. We're working on round-the-clock renewables. But the issue is often we suffer from a bit of data lag or data security issues. I mean, if I really wanted to, say, run a round-the-clock renewable power supply for an electrolyzer project in situ with a steel plant somewhere in eastern India, and my target or strike price would be 4.8 rupees, and beyond that the guy is going to say, oh, I'm going to buy grid power. So if I needed to kind of turn it and make it into a round the clock, put in solar, wind, hydro, all of it together, we often have the structure in place, but we don't really have the real-time data. So a lot of times my request to the IPPs and the OEMs is, please come forward and at times, within limits of your confidentiality, share some technical data so it's easier for you in the long run. Because if people can structure in a round-the-clock renewable supply for green hydrogen projects, the electrolyzers need to run continuously. Or for process industries, round-the-clock renewables, we need, for that structure, we need actual hard data and not just theoretical stuff. So at times, I mean, we have to basically beg, borrow, and often be stymied and say, oh, we don't want to talk to World Bank. They're economists. I mean, what do they understand about engineering? So if it is possible, and this is a request, please come forward, throw ideas at us. We are happy to discuss, and possibly we will come to something which can make use of the 500 gigawatt we are actually talking out there. Because you can have all the capacity and no takers for it, and then, of course, there is no more PPAs and PSS signed. So that's one part. And the second part, honestly, it said, how can we diversify? I think about it and I say, if you have Canada pension funds and the Quebec pension funds coming in, why can't we have, and honestly, we are looking at 7.5% to 8%, risk managed returns, which is definitely possible with a whole bunch of renewable energy projects. So why don't we make it into REITs? 250 or 300 megawatt projects, SPVs made into REITs, and kind of sold off in the retail market, maybe, because a lot of people I see, I look at the share market and it's going up, and I realize people have an appetite for a 7.5% or 8 or 9% investment return on a long-term basis. So I think this is one way of getting it. A, REITs, B, pension funds. I mean, the LICs of the world go in and try and bail out random banks and companies. Why not come in here and put some money and at least get a 7.5% or 8% return on investment for your investors? I mean, that's your mandate. Your mandate is not 20. So why don't you look at that? I mean, just two thoughts from me. Thank you.
Thanks, Satyaki. Ashish, your closing thoughts.
So, no, I think the time is over. So, that future is for the RTC. So, the funding for RTC right now will not be an issue, but in future there will be issue. What we seen earlier that wind, the tariff was 5, now it's below 3. The solar tariff started from 15 rupees, now it is around 2 to 2.5. Similarly for RTC, as of now, that definitely the cost of green hydrogen and the battery storage will be going to come down maybe coming years. So how will lenders see, and then the industry seek, that will there be any threat to the current projects with the higher tariff, and what will the scenario? So these kind of challenges, that we have to be ready as the industry to face maybe in coming years. Thank you.
Thank you so much. In the interest of time, and since all the panelists have been very, very explicit in what they wanted to say, I don't think I should be summarizing what they said. It's just repeating what they said. But I would like to just make one point, and this is with reference to what Satyaki pointed out on the data access and availability, particularly granular data and near real-time data, is what he was referring to. We at Vasudha Foundation have realized that, data is not very easily available, or even if it's available, one will have to look through multiple documents, multiple dashboards, multiple repositories, and it's not very easy to bring them together. So with that in mind, a couple of years back, we started an initiative to bring all those data together and make it access to all without any paywalls and easy to access. And that brought us, that's how we developed a site called a data portal called the vasudapower.in that has data for the entire power sector value chain. And it is near real time and granular to the extent that we also have data from the at the DISCOM level. And I'm also happy to inform you that very soon this site is going to be merged with Niti Aayog's climate energy dashboard. In fact, the name will no longer be vasudapower.in. From a week's time, it will be called edm.gov.in. And I would encourage all of you to visit that site for any information on the power sector value chain, right from generation, looking at demand, distribution, demand, the DISCOM health, the entire works. It has that. And we also have a stall here in 129, and we'll be happy to demonstrate the site and how you could use it. So I just thought I would inform you. In addition to that, I would also like to say that we also developed a tool with the Nature Conservancy taking the lead, which is called the SiteRight tool, that tries to helps to identify land parcels for utility scale solar and wind projects in India, factoring in both social and environmental values. So that we could also demonstrate the tool, and there's a small video clip playing that in the booth of ours. With that, thank you very much, and I hand over the floor to the MC.
Yeah, thank you, Mr. Krishnaswamy. Thank you also for sharing with us about your data repository, a complete treasure for the entire industry. With that, may I request you, sir, also to kindly present the mementos to our speakers. Thanking Mr. Saurabh Maggo. My expression of thanks to Mr. Pankaj Sindwani. Thanking Mr. Satyaki Bhattacharya. Many thanks to Mr. Ashish Tiwari. And request Mr. Giri to kindly present the memento, thanking our session moderator, thanking Mr. Krishnaswamy. And a group photograph, we'll close with that. So the next session, ladies and gentlemen, in fact, these two sessions which we have, both merging with each other, because we have a special address by Ms. Gauri Singh, the Deputy Director General of IRENA, the International Renewable Energy Agency, which is an intergovernmental organization supporting countries in their transition to